Hello and welcome back to UK Property Info, your trusted source for comprehensive real estate news, market analysis, and expert insights into the ever-changing landscape of British property. I am delighted to have you with us today as we delve into what has become one of the most significant developments in the UK housing market in recent memory. Today, we are examining a phenomenon that estate agents, property developers, investors, and homeowners across the nation are calling the Big Freeze, a dramatic slowdown that has brought the once bustling UK property market to what can only be described as a standstill. Before we dive deep into the analysis, I want to take a moment to thank each and every one of you who has supported this channel. Your engagement, your comments, and your continued viewership make it possible for us to bring you these detailed reports. If you have not already done so, please consider subscribing to UK Property Info and hitting that notification bell so you never miss an update on the stories that matter most to your property investments and homeownership journey. Now, let us address the elephant in the room. The UK property market, which for decades has been characterized by its resilience, its ability to bounce back from economic shocks, and its reputation as a safe haven for investment, has entered a period of unprecedented stagnation. Transaction volumes have plummeted to levels not seen since the aftermath of the 2008 financial crisis. Asking prices, while nominally stable in many regions, are masking a reality where actual sale prices are being negotiated down significantly. The time properties spend on the market has extended dramatically, and perhaps most tellingly, the confidence that has traditionally underpinned British property investment has been shaken to its very core. To understand how we arrived at this juncture, we must first examine the confluence of factors that have contributed to the Big Freeze. It would be overly simplistic to point to any single cause, as the current market conditions are the result of a perfect storm of economic pressures, policy decisions, global uncertainties, and shifting demographic patterns that have fundamentally altered the property landscape. Let us begin with what is perhaps the most immediate and visceral factor affecting the market, and that is the interest rate environment. After more than a decade of historically low interest rates that fueled property price growth and made homeownership accessible to millions, the Bank of England embarked on an aggressive rate hiking cycle in response to inflationary pressures. These increases, which saw the base rate rise from near zero to levels not experienced since before the global financial crisis, have had a profound and far-reaching impact on the property market. For prospective buyers, particularly first-time buyers who represent the foundation of any healthy property market, these rate increases have been nothing short of devastating. A young couple looking to purchase their first home has seen their potential mortgage payments increase by hundreds of pounds per month compared to what they would have been just 2 years ago. This is not merely an inconvenience. For many, it has made the dream of homeownership mathematically impossible. The affordability calculations that lenders use have tightened significantly, meaning that even those with stable employment and reasonable deposits find themselves unable to borrow the amounts necessary to purchase even modest properties in many parts of the country. The situation for existing homeowners approaching the end of their fixed-rate mortgage terms is equally concerning. Millions of households locked in rates of 2% or less during the pandemic era are now facing the prospect of remortgaging at rates that are 3, 4, or even 5 times higher. This mortgage rate shock has created a phenomenon where homeowners who might otherwise have considered moving are choosing to stay put, contributing to the freeze in market activity. Why would you sell your home and take on a new, significantly more expensive mortgage when you can simply remain where you are and weather the storm? This brings us to a critical aspect of the current market dynamics, which is the breakdown in the traditional property chain. The UK housing market has always functioned as an interconnected system where one sale enables another. First-time buyers purchase starter homes from young families who then move up the ladder to larger properties, which in turn are vacated by older homeowners downsizing into retirement. When any link in this chain breaks, the entire system seizes up. What we are witnessing now is a comprehensive breakdown across all segments of the market, creating a gridlock that has no easy solution. The rental market, often seen as an alternative for those unable or unwilling to buy, has experienced its own set of challenges that have paradoxically contributed to the freeze in the sales market. Landlords, facing increased regulatory burdens, the phasing out of mortgage interest relief, and the prospect of further legislative changes, have been exiting the buy-to-let sector in significant numbers. This exodus has reduced the available rental stock precisely at a time when demand for rental properties has surged due to frustrated would-be buyers remaining in rented accommodation. The result has been dramatic increases in rental prices, which, while beneficial for remaining landlords, have made it even harder for tenants to save the deposits necessary to transition to home ownership. From a regional perspective, the Big Freeze has manifested differently across the United Kingdom, though nowhere has been entirely immune. London, which traditionally leads market cycles both up and down, experienced the first signs of the slowdown and has seen some of the most significant price corrections in percentage terms. The capital's property market, long propped up by international investment, has been affected by a combination of factors including changes to overseas buyer stamp duty surcharges, geopolitical uncertainties affecting traditional sources of foreign investment, and a fundamental reassessment of the value proposition of London living in a post-pandemic world where hybrid working has become the norm. The southeast of England, particularly the commuter belt areas that saw enormous price growth during the pandemic as buyers sought more space and garden access, has experienced what can only be described as a reality check. Properties that were subject to bidding wars and sold for significantly above asking price just 18 months ago are now sitting on the market for extended periods, with sellers being forced to accept offers considerably below their expectations. The dream of the countryside lifestyle that drove so many purchases has, for some, given way to the practical realities of commuting costs, limited local amenities, and the isolation that can come with rural or semi-rural living. In the north of England, Wales, and Scotland, the picture is more nuanced. Some areas that were previously considered undervalued have shown greater resilience, benefiting from ongoing leveling up initiatives and infrastructure investments. Cities like Manchester, Leeds, and Birmingham, which have developed thriving local economies and attracted significant corporate relocations, have maintained relatively more active markets, though even here, transaction volumes are significantly below their peaks. The relative affordability of these regions compared to the South has provided some insulation against the worst effects of rising interest rates, though this advantage diminishes as rates remain elevated for longer periods. The new build sector, often seen as a bellwether for market confidence, has been particularly hard hit by the Big Freeze. Major house builders have reported significant declines in reservation rates, leading to reduced construction activity and the postponement or cancellation of planned developments. This slowdown in new construction has obvious implications for the government's housing targets, but it also creates long-term supply constraints that will inevitably contribute to future price pressures once market conditions eventually normalize. The skilled labor that leaves the construction industry during downturns does not always return, and the planning permissions that expire unused represent opportunities lost that cannot be easily recovered. For property investors, both domestic and international, the Big Freeze presents a complex picture of risks and potential opportunities. On one hand, declining prices and desperate sellers can create buying opportunities for those with available capital and a long-term investment horizon. On the other hand, the uncertainty about where the bottom of the market lies, combined with the ongoing costs of holding property in a high-interest rate environment, makes timing such investments extraordinarily challenging. Many investors have adopted a wait-and-see approach, preferring to hold cash and observe market developments rather than deploy capital in what remains an uncertain environment. The commercial property sector, while not the primary focus of our channel, deserves mention for its interconnections with the residential market and its indication of broader economic sentiment. Office vacancy rates in major cities remain elevated as businesses continue to reassess their space requirements in light of changed working patterns. Retail property continues to face structural challenges from the shift to online shopping, though there are pockets of resilience in experiential retail and well-located high street properties. The industrial and logistics sector, which was the darling of commercial property investors during the pandemic, has seen valuations moderate as the e-commerce growth trajectory has normalized. What does all of this mean for the average homeowner, the aspiring first-time buyer, or the property investor watching this report? The honest answer is that we are in uncharted territory, and anyone claiming to have definitive answers about where the market goes from here should be viewed with healthy skepticism. However, there are some observations and principles that can help guide decision-making in this challenging environment. For current homeowners, particularly those not facing an imminent need to move, the prudent approach may be patience. Property is inherently a long-term investment, and trying to time the market perfectly is a fool's errand that even professional investors rarely accomplish successfully. If your current property meets your needs and your mortgage payments remain manageable, there is much to be said for stability and avoiding the costs and stresses associated with moving in a difficult market. Focus on maintaining your property, consider improvements that will enhance your living experience regardless of their impact on resale value, and ensure your financial position is as robust as possible to weather continued uncertainty. For those who must sell, whether due to relationship breakdown, job relocation, financial necessity, or other life circumstances that do not wait for convenient market conditions, realistic pricing and presentation have never been more important. The days of testing the market with optimistic asking prices and waiting for a buyer to appear are emphatically over. Properties that are priced competitively from the outset, presented immaculately, and marketed effectively through agents who understand the current environment are still selling. Those that languish on the market month after month, accumulating price reductions that signal desperation to buyers, face a much harder path. Pride in what you paid for a property or what you believe it should be worth must give way to pragmatic acceptance of what buyers are actually willing to pay today. First-time buyers face perhaps the most difficult decisions in the current market. On one hand, the combination of lower prices and the potential for further declines creates an incentive to wait. On the other hand, life does not wait indefinitely, and the costs of renting continue to rise while you delay. There is also no guarantee that lower prices will coincide with lower interest rates. Indeed, prices have fallen precisely because rates have risen, and a scenario where prices fall further while rates also decline represents a combination of circumstances that may prove elusive. For those with secure employment, adequate deposits, and a clear understanding of their affordability at current rates, buying a home that meets your needs for the medium to long term remains a valid decision, even if short-term price movements may go against you. For property investors, the big freeze demands a fundamental reassessment of strategy. The leverage-driven approaches that worked spectacularly well during the era of ultra-low interest rates can quickly become destructive when rates rise and capital values fall simultaneously. Investors with significant mortgage debt on their portfolios need to stress test their positions against scenarios where rates remain elevated for extended periods and where voids or tenant payment difficulties coincide with high carrying costs. Those considering new investments should be running the numbers on yields that make sense at current mortgage rates, not on optimistic projections of rate declines that may or may not materialize. Cash flow positivity, which was often sacrificed in pursuit of capital growth during the boom years, should return to its rightful place as the cornerstone of sound property investment strategy. Looking at the broader economic context, the big freeze in the property market is both a symptom and a cause of wider economic malaise. Consumer spending, a major driver of economic growth, is directly affected by the wealth effect of housing. When homeowners feel poorer because their property values are declining, or when they are directing more of their income toward mortgage payments, they reduce spending on other goods and services. The construction industry, directly impacted by the slowdown in new building, is a significant employer that supports extensive supply chains. Estate agents, solicitors, surveyors, removal companies, and the many other businesses that depend on property transactions are all feeling the pain of reduced activity. This creates a negative feedback loop that can be difficult to break. Government policy responses to the big freeze have thus far been limited and arguably insufficient to address the scale of the challenge. The various stamp duty adjustments and first-time buyer incentive schemes that have been deployed represent tinkering at the margins rather than fundamental reform. There is a growing recognition among policymakers that the UK's housing market suffers from structural problems that require structural solutions, but the political difficulties of implementing meaningful change, particularly anything that might negatively affect existing homeowners who represent a significant voting bloc, have constrained action. Planning reform, which could address supply constraints over the long term, remains contentious and subject to local opposition that politicians are reluctant to override. The result is a policy environment that is reactive rather than proactive, addressing symptoms rather than causes. The role of the Bank of England in all of this cannot be overstated. The Monetary Policy Committee faces an unenviable task of balancing the need to control inflation against the damage that high interest rates inflict on the property market and broader economy. There are those who argue that rates have already risen too far and too fast, pointing to the lagged effects of monetary policy and warning that the full impact of rate increases has yet to be felt. Others maintain that inflation remains too high and that premature rate cuts would risk embedding inflationary expectations in a way that would require even more painful policy responses in the future. The bank's communications, closely parsed by market participants for any indication of future policy direction, have been characterized by caution and an emphasis on data dependency rather than forward guidance. International factors continue to influence the UK property market in ways that are sometimes overlooked in domestic analysis. Global inflation, supply chain disruptions, geopolitical tensions, and the policies of other major central banks all have implications for UK interest rates, economic growth, and property values. The strength of sterling affects the attractiveness of UK property to international buyers, while global risk appetite influences the availability and pricing of mortgage finance. The UK does not exist in isolation, and the resolution of the big freeze will depend in part on developments beyond our shores and beyond the control of UK policymakers. As we consider what the future might hold, it is worth reflecting on previous property market downturns and what they can teach us. The early 1990s crash, triggered by the combination of high interest rates to defend sterling's position in the exchange rate mechanism and the broader recession of that period, saw nominal price falls of over 20% in some areas and took years to fully recover. The 2008 financial crisis produced a sharp but relatively brief correction, with prices recovering within a few years thanks to unprecedented monetary policy support. Each downturn has its own characteristics, and while history can provide useful context, it would be a mistake to assume that the current situation will follow any particular historical template. What we can say with some confidence is that the fundamentals of UK housing remain unchanged. The country has a chronic undersupply of housing relative to household formation, a situation that has persisted for decades and shows no sign of being resolved in the near term. Land availability, particularly in areas of highest demand, remains constrained by geography, planning restrictions, and the legitimate desire to preserve green spaces and heritage assets. Population growth, while moderating, continues, and immigration, whatever one's views on the policy aspects, adds to housing demand. These supply-demand dynamics provide a floor under prices that does not exist in all markets and suggest that fears of a complete market collapse are probably overstated. However, a floor under prices is not the same as a catalyst for recovery, and there are credible scenarios where the big freeze persists for an extended period. Japan's experience following the bursting of its property bubble in the early 1990s, while not directly comparable, serves as a reminder that property markets can experience prolonged periods of stagnation when underlying economic conditions are unfavorable. A scenario where UK property prices drift sideways in nominal terms for several years while inflation erodes real values is entirely plausible and would represent a significant departure from the experience of most current market participants who have known only a market where prices trend inexorably upward over the medium term. For those of you who have stayed with us through this comprehensive analysis, thank you for your attention and engagement. The property market affects us all, whether as homeowners, renters, investors, or simply as citizens of a country where housing policy has profound social and economic implications. Understanding the forces shaping the market, even when that understanding leads to uncomfortable conclusions, is the first step toward making informed decisions in your own property journey. At UK Property Info, we remain committed to bringing you objective, thoroughly researched, and practically useful analysis of the UK property market. We do not have a vested interest in talking the market up or down. Our only interest is in providing you with the information and perspective you need to navigate whatever conditions prevail. We will continue to monitor developments, speak with industry experts, analyze the data, and bring you regular updates as the big freeze evolves. The coming months will be critical in determining whether the current standstill represents a temporary pause before renewed activity or the beginning of a more prolonged period of market adjustment. Interest rate decisions, economic data releases, government policy announcements, and the countless individual decisions of buyers and sellers across the country will collectively determine the market's direction. We will be here to help you make sense of it all, cutting through the noise and hype to bring you the insights that matter. If you found this report valuable, please take a moment to like the video, leave a comment with your thoughts and observations about the market in your area, and share it with others who might benefit from this analysis. Your engagement helps us reach more viewers and supports our ability to continue producing this content. And if you have not already subscribed to UK Property Info, please do so now and enable notifications so you are always among the first to know when we publish new content. The big freeze is a challenging time for all participants in the UK property market, but it is also a time that will create opportunities for those who approach it with clear eyes, realistic expectations, and sound strategy. Properties will still be bought and sold, investments will still be made, and for those with the right approach, wealth will still be created. Our role is to help you be among those who emerge from this period in a stronger position than they entered it. Thank you once again for watching UK Property Info. This has been our special report on the big freeze in the UK property market. Take care of yourselves and your property investments, and we will see you in the next video. Until then, stay informed, stay prepared, and remember that in property, as in life, this too shall pass.